What is structuring in your mind?
Structuring is the leveraging off a variety of different legal entities in which you can work or operate or hold investments. Like two of the obvious ones would be trusts or a family trust. The other one would be a self-managed super fund.
So if we use the builder example once again, something goes wrong in your business, you get sued. Can they come after your house, say, for example, it's held in trust?
If it's held in trust, it makes it a little bit more challenging. If it's held in your name and you're, as a director, are personally liable for something, then of course, yeah, they can come after you and your family harm.
Small and medium-sized business owners out there listening to this, chances are they may hold businesses or assets in their personal name and they want to maybe protect themselves. What are the first steps? What do you actually do? What about something as simple as your best mate says, AB, I need to borrow 250 grand cash right now?
If somebody came to me wanting to borrow money, it's just a hard no.
Yeah. Even a binding financial agreement you can get drawn up before you get married. So say you're de facto and you live with someone, that's also important too, because there could be a claim on your assets in that moment.
100%. And the whole game of money, I suppose, is capital preservation ultimately at the end of the day, and where things like a binding financial agreement are very handy. Hey guys, quick question for you. How safe are your assets? What are your risks of getting sued? What happens if you get divorced? The hard work that you've put in to build your wealth, is it as safe as you think it is? In this episode, Mitch and I are going to explore some of the structuring techniques and pathways that you can take, the benefits of them, and most importantly, the pitfalls to avoid. This is by no means a substitution for advice, as you'll hear loud and clear. Make sure you get great advice. But most importantly from this, take heed of the experiences that we've had. See you in the show. Hey guys, welcome to this week's Money and Investing Show with me, your host, Andrew Baxter, and as always, my offsider and co-host, Mitchell Olarenshaw.
Detail-orientated is the outfit, and detail-orientated we shall be today. AB, good to be here. We're talking about structuring our investments for maximum protection.
I'm fixated with structuring those loafers, mate. They are a pair of brothel creepers, if I've ever seen some. Very smooth.
Italian Riviera type look.
Yeah, it's looking good. It's looking good. You just need the jumper slung over the shoulders, and you'd be the full Monty.
Wait till winter, and you'll see. Nice sock game too, by the way.
Got to raise it. Got to offset this tie. It's a lot of tie to carry, mate.
Now, for anyone not watching and just listening to us two clowns talk, let's get started. So, structuring advice is something that typically a financial advisor or an accountant would provide. But I guess we can kind of give some general framework today to give people the heads up on what's out there. Because let's face it, we work hard for our money. We work hard to save and invest, and losing it or squandering it is a real risk we have here.
Too right. I mean, it's not what you make, it's what you get to keep at the end of the day. And we do live in a litigious world where, structuring can at least help you in protecting your assets. That's for sure.
Yeah. So by definition, at least briefly, what is structuring in your mind?
So structuring is the leveraging off a variety of different legal entities in which you can work or operate or hold investments. And like two of the obvious ones would be trusts or a family trust, which many people would have heard of. The other one would be a self-managed super fund as a way of parking assets too. And the challenge is, I guess, what's your outcome from the structuring you're looking for? Are you looking for asset protection, or are you looking for tax efficiency? Because they're not necessarily the same thing.
Okay, well, I guess the question we're all probably asking is, can you get both in the same, which I'm sure we'll cover throughout. So why don't we start with SMSFs? What are they good for? What's the taxation like? Yeah,
look, I mean, self-managed super, like any super, is taxed at 15% currently. They're not impervious to legal challenge. Certainly they fall within the purview of the family court, for example, if you're going through a divorce.
Really? So if you've got a self-managed super fund, which you've contributed most of, and you get divorced, it could be split up.
Could still be split up, yeah. So it's not beyond reach, but obviously at a tax rate of 15%, it does become something that's quite attractive. And there are a number of rules that can enable you to bring forward contributions or catch-up contributions to try and optimize what you've got there. And if you're someone, let's just give an example. Let's say you're a builder or you have a building business. You have a yard. You might own that commercial property within your super and then rent it to your business for use. It needs to be documented properly, arm's length transaction, needs to be at commercial rates and so on and so forth. But I guess you then go from being a business that's paying rent to Joe Blow to paying rent to yourself, and albeit you're paying that rent out at a more tax effective rate for you to receive.
So you get the deduction out of your company and you get the income at only 15% in your
So you've got that carry of a better tax rate.
Very nice.
And that's something that's not uncommon. It does need to make sure that it meets the scrutiny of of the ATO for all of that. So it does need to be an arm's length transaction. You can't overcharge for your rent to try and gouge more out of your business. There are a number of, you've got to get a valuation done on the property every year. There are things like that sit in there as safeguards to ensure you're playing the game carefully. But there's an example of utilizing a structure there that could assist. Equally, actually talking about having a business versus in a personal name. If you own property in your own name, obviously if it's your primary place of residence, there's no capital gains tax on it. If you own property in other structures, whether that be a trust or a company or within your superannuation, they're not capital gains tax free. That's the benefit you get from holding it in your own name. If it's your primary place of residence, you obviously can't own a primary place of residence in your superannuation fund. It doesn't meet what's called the sole purpose test. So where you live can't be the property that you own in your super. It's got to be commercially rented out. So
it's not very tax efficient, so to speak, I guess you could argue, to own it outside of your personal name. What about from a protection standpoint of view? So if we use the builder example once again, something goes wrong in your business, you get sued. Can they come after your house, say, for example, that's held in trust?
If it's held in trust, it makes it a little bit more challenging. If it's held in your name and you're, as a director, are personally liable for something, then of course, they can come after you and your family home. And this is one of the reasons for setting up a business as a proprietary limited. So the business liabilities sit within the business and it's contained in its own legal entity, so to speak, to try and avoid that bleed across to you, a director or owner of that business, where potentially your family home could be at risk. If a property is held within a trust, and that's a further level of protection that's away from you individually, because if you were sued individually, for example, for some form of damages, and they go, well, you own a property over here, so yeah, but that's owned by the trust. I'm not the trust is its own legal entity, then it becomes a little harder for creditors, for example, or a litigant to go after that. They still can, but it becomes by a degree significantly harder to do that, which from an asset protection perspective, if you're someone that's in a higher risk position as a business owner, for example, then that you've got to make sure that you do all of that to keep your assets safe.
So I guess, really what we're looking at here is just creating that sort of one arm's length away for someone to come after you for assets.
And again, you can push further and further out, and each iteration of pushing out gives you a further layer, if you will, or shell of protection. So, you could have a trust which owns a company, which is the trustee company for another trust. So you're starting to really put some air between you and risk. And, you do need to get professional advice on this. This is by no means chapter and verse on what to do for asset protection, but there are lots and lots of things that you can do.
So a question for you on trust then specifically. There's multiple different kinds of trusts you can have: family trust, bloodline trust, unit trust. Just briefly on the major ones that most people would consider, what are the differences, pros and cons?
I've got a buddy of mine, he loves bloodline trusts, as its name would suggest, and I guess these sort of came about, I'm not going to say initially, but quite often used in old farming families, whereby, the asset of the farm is held within that bloodline trust, and it goes to the bloodline, not the spouse of the bloodline, but the bloodline in itself. So the beneficiaries, primary, secondary beneficiaries, are all in that one line or lineage to keep a operation, business, whatever it might be, within the, as its name would suggest, the bloodline of the family rather than anybody else. They're open to challenge in court, as everything is. Nothing is impervious, but it is a level of protection. Family trusts are great. You can have your family members in there, or not, as the case may be. If you want to preclude somebody, you can, because within that structure, the beneficiaries of a trust are ultimately the people who have the asset. The trustees are the people that direct where that asset goes. And there is another layer that's further up than that, which is called the appointor. And the appointer is the person that appoints the trustees. Oh, wow. So in an ideal world, you want to be the appointer that has 100% control of what's going on, but none of the ownership. And therefore, the assets, if somebody comes after you, well, you don't own the assets. You simply have control of them.
And a unit trust, last and finally?
Similar sort of thing, but the units then divided pro-rated across the number of units that you might have. So, in an example, your partner might have 50% of the units in that trust, and each of the kids 10%, 5 kids 10% each. And if there's a distribution, it's not paid out pro-rata across all parties. It's paid based on the percentages that sit in there.
Interesting. There's so many layers, isn't there?
Yeah.
Who would have thought?
Again, you got to get advice on this. We're just having a broad conversation around this. It does become really important. I think where is the time to consider structuring is also a really pivotal question in all of this, because when people get involved, let's take our lane, the investing space, for a moment. We say to people, if you've got an entity to use, you can use it, because if you just take tax, for example. So if you're taxed at 47 cents in the dollar versus a company that might be 30 or 25, what's the difference? Well, if you've got a business that's actively doing something, the tax rate within it 25%. If it's just a holding or investment company, it's probably 30% tax rate. If it's your super, it's 15. So if you've got those different avenues from a tax perspective that you can utilize, clearly, we want to try and put your gains in the most optimal place for you. The challenge, if you put them in super, is you can't draw them out until you're ready to retire, so you don't have access to the money. If it's in one of the other entities and it's a lower tax rate, well, that can be quite handy for you. But if you don't have any of those structures, that's a big barrier to entry. Going, I want to get started, but I got to go and get incorporated and do that. Just get started in your own name. That's the first thing. But as you start to move forward and start to become more substantial in what you're doing, it's a conversation with your accountant to say it's probably getting to the point where I should get some structuring advice. So if you were to take property as an example, the transaction fees for property are quite hefty. You've got stamp duty, amongst other things, to consider in there. So making sure before you buy a property, you park it in the right place is key, because if it's not in the right place and you've got to transfer it to the right place, you're going to pay a lot of stamp duty that you shouldn't need to pay because you didn't get the advice early enough. So that's an example of where before you do the transaction, you need to get advised. Whereas if you're starting a share trading account with 10, 20, 30 grand, that's probably less of an issue.
Got you. Okay, what about the other side of this? What about things like, say, prenups and binding financial agreements? That's less of a structuring, but more of an asset protection method you can take beforehand, right?
Yeah, look, prenuptial agreement, my wife is a family lawyer. She's been on this podcast and talked a little of some of these things. And look, prenups don't always stand up to scrutiny if you go to the family courts.
I'd love to know the percentage. Is it worth actually getting one or not? Right?
I think it provides a framework. It's just a question of when it was done and how it was done and how fair it probably is, because circumstances change. You can also get postnuptial agreements too, where after your marriage you could get that put into play too.
Interesting. Okay.
That'll be a pretty hard sell. You're out for a romantic dinner and you just sort of slide the document bundle across the table. Just sign there for me, would you please? What's this? That will be quite challenging, I think. But again, that's part of the family law lane of trying to protect assets. And typically, from conversation with my wife, first marriages, a lot of people don't have a prenup. If there's quite a difference in wealth going around again for a second or third marriage, that typically is where you see those documents actually kick in on a far more frequent basis, which is understandable. If you've gone through a separation and you've divided your asset pool up and you're going in again and you've got a reasonable asset pool, you do probably want to be a little bit more careful this time to ensure that, for example, that your kids are provided for.
Yeah, I think it makes sense. I think for anyone who's aiming to or has a level of wealth, then you've got to have these things in place, assuming it's communicated in the relationship, which is, as you say, the hardest part. Even a binding financial agreement you can get drawn up before you get married. So say you're de facto and you live with someone, that's also important too, because there could be a claim on your assets in that moment as well.
100%. And the whole game of money, I suppose, is capital preservation ultimately at the end of the day, and where things like a binding financial agreement are very handy. These are especially useful if there's quite a difference in what either party are bringing to the equation, or if for example, one party is moving in for the first time with the other party. So let's say, for argument's sake, you owned a piece of real estate and then your partner moved into that as you started to date, and then becomes a de facto relationship, which then opens up a whole can of worms in terms of a claim against that asset. A binding financial agreement would be, okay, let's just, before we get too serious, work out if things go wrong, this is what you're bringing in, this is what I'm bringing in, and this is what the exit looks like. And if it's appropriately drafted by an appropriate lawyer and it's obviously witnessed and executed properly, then that can give you a basis for a more amicable split up than if you're going at hammer and tongs and saying, no, I'm going after you for this, that, and the other. I think it's just really worth noting that circumstances change. So you could well have a binding financial agreement as you go in, and then once you've got married or if you've had kids, that whole equation may be adjusted because the status quo has shifted. Again, this is why it's so important to get professional advice from qualified, licensed or appropriately qualified experts in each of these lanes.
The last but not least on this list, we've done trusts, SMSFs, BFAs, prenups. What about just a straight contract or an agreement? So say you're doing a development with someone, with a business partner, having something in writing. I think a lot of people forget they do it on the handshake or he's a friend, I can trust him. Is that always the case?
No.
I think any personal you would like to, without naming names, experiences you'd like to share?
I think everything is always hunky-dory on the way in, and it's not the way in. It's no different to a trade. You always look at a trade, I want to get in this trade, it's a good trade. The real work is how am I getting out of this trade, either in the perfect scenario or if it all goes horribly wrong, how am I getting out of it when things go wrong? That's where the work is in any kind of investment or trading strategy, and we do that very, very well. The same is true for getting into an agreement with someone. Oh yeah, we're best mates, let's go and do this together. It'd be great fun to make some money together. We go travel together, all great on the way in. But when the wheels come off, that's where things can get a little bit hairy. And I think, in that sense, obviously having a contract is essential. Who's responsible for what aspects of what's going on? If there are director guarantees, which can often be the case. So, for example, you've taken on some commercial premises, as an example, when you're a leaseholder, you very likely have to provide a personal guarantee as a director. So which one of you or both of you is doing that? How's the ball bouncing? Does the other side actually have any cash behind them? Or are you in a situation where, let's take development, where they might have the building expertise and you might have the coin. So you go, let's do a JV. And you, being the person that puts the coin in, are on the hook for all things financial, and they're on the hook for anything that's building related. That's really, really murky territory. And if it does go wrong, which at some point it most likely will, you've got to form a friend. I can speak to that in volumes where I've been touched up on that quite badly, where I was an equity partner in something, or I put the money into a development. They were the builder, and they went bust and hightailed it, and I was sort of stuck with the problem on the other side. So I can speak firsthand that those sort of agreements typically aren't great. And he's still into me for some cash. I'm sure he's living somewhere else in the world now and rebuilding. But that's just something that just cost you a friendship and obviously some dollars too.
What about something as simple as your best mate says, AB, I need to borrow 250 grand cash right now?
Yeah.
I mean, you could loan it to him.
Yeah.
Do you get something drawn up? Because 250 grand is still 250 grand.
If I look back at the different chapters of my life, and I think everything you do has to be a learning experience, good, bad, or indifferent. And there was a time, probably about, I'm going to say 15, 18 years ago, where I fell foul of that a couple of times. And I loaned someone some money. They were buying a house and they needed to show they had funds. It's just a casual friend of mine, not someone that was a best mate. And I loaned it. It was a reason. Thinking back, it's a really crazy decision to lend someone a reasonable sum of money. And they needed a bed and breakfast money in his bank account and returned it within a week. And I think, well, what if he didn't? I only thought about that subsequently, because at the time you go, he's a mate, he'll pay it back.
Of course. What if he didn't?
Because you hold your friends to a higher level of accountability than Joe Blow down the road. Equally, I've had a different situation where one of my mates was in business and he was struggling to make his payroll, and I said, I'll give you a hand and helped him make his payroll, and I never got the money back.
Never.
And I didn't get any thank you from one of the people whose payroll I paid. Really turned on me quite nastily, going, "Oh, you did this, you did that." It's like, mate, you last 3 months you've been paid. It's because of me. Mm-hmm. So let's just tone the dialogue down a wee bit. People have got very, very short memories there, and you write that off as one of life's experiences. So to that point now, if somebody came to me wanting to borrow money, it's just a hard no.
No matter who it is,
it's just a hard no.
Yeah,
and and you can look at that on various levels, in life. And my grandfather, a Yorkshireman at heart, a wonderful man. My grandfather, the most beautiful relationship with him. I miss him every day. He always had an expression: "I'll lend it to you until such times as I need it back, and if there's something wrong with it, you'll replace it."
Yeah. Okay.
And my dad is similar. That was my maternal grandfather, but my dad is quite similar actually, insofar as, look, that's okay, I'll lend it you. And he's one of the kindest people on the planet. My father is just a beautiful man. But you'll need to return it in the condition it was lent. And I've more recently, over the last couple of years, have had people try to borrow different things from me, and it's just like, no. And it's not because I'm uncharitable. It's like it's absolutely ridiculous. Somebody wanted to borrow. We're chatting about this is how crazy and boring your life gets when you live in the country and you've got kids and all the rest of it. We're talking about pool cleaners, and I happen to have 2 pool cleaners because I like a nice clean pool. So I've got the one in the pool, and then I've got a brand new one in the box in the shed. And it's only because I've had some warranty issues that I've got a new one that's sitting in the shed to replace. Anyway,
You don't have an obsession with pool cleaners, I hope. So you're not stacking them.
no, it's not.
Anything.
I've got more cars than pool cleaners.
Okay, that's good. That's a start.
But the notion, he said, "Oh, you know, you look at that spare pool cleaner. We've had some ducks in our pool." I said, "Oh yeah." He said, "Can I borrow it?" And it was like, "No."
How'd that go down?
Well, it's just what it is. I said, if you need you need a pool cleaner. It's not something you can borrow. You need one on every day.
Just go and buy one.
Your creepy crawly or whatever the thing is that you use in your pool. You need one anyway. So why would you want to borrow one when you need one? And yeah, you've had some ducks in your pool, so it's really, no pun intended, foul. There's a dad joke for you. Feather in my nest today, hey? Let's get down to business. Otherwise, I'll drive you quackers. I can go on with these all day.
Yeah, okay.
Joys of having so many kids. And I said, like, you probably don't want to buy one because your pool's a shocker at the moment. So you'd rather use my brand new one to get it semi-clean before you buy one to put in, which means my new one that I'm lending you is now knackered. It's just like, how do you rationalize that in a conversation?
Because we're friends.
Yeah, and it's like, nah, just go and get one. Yeah. You're going to need one anyway, so there's no point in borrowing it unless you're going to use mine and then buy a new one for me, and you can drop a new one in the box for me and keep the one I'm lending you. That's cool.
Yeah.
Oh no, I wasn't planning on doing that. Well, that's okay. The answer is no.
Interesting.
And you know, and it's, as I say, it's not to be uncharitable. It's just that, okay, the net loser in this trade is me, because I'm either going to get something back that's busted, used, no longer fit for purpose, or whatever.
Well, you might not get it back
Or
altogether.
I might not get it back at all, which then puts a strain on the friend. How many times do you have to call someone, hey, can I get that cleaner back?
Yeah.
You know, that is just a small thing that just happens in everyday life.
Yeah.
That's it. You know, well, yeah, there are people inside your tent, of course, you lend stuff to, family. It's like, well, how do you need this? You're going to get that. But
Gotcha.
I'd rather come and help you. Say, oh, I'll come and give you a hand. I've got plenty of time. I'll come and do it with you.
Yeah.
How about that?
Yeah.
And that's I think more valuable. So no, I think if someone hit me up and said, you know, can I borrow some cash? There'd just be a hard no these days. And the irony is, I've got much more asset base to be able to do that. But I've learned the lesson of being burned a couple of times. And I think it's not often you'll hear me quote this fountain of knowledge, George W. Bush, not H.W., George W., the son. What was it? Fool me once, shame on me. Fool me twice, shame on you. He got the quote totally wrong, right? It was like, no, fool me once, shame on you. Fool me twice, shame on me is what he meant to say. And that's the thing. So if you've been burned with something and you don't learn from it and get burned a second time, it's actually your own fault for not learning from your mistakes.
Of course. Yeah.
So that sort of notion of, just lending people stuff, if it's secured or it's a private lending arrangement, maybe that's a little bit different, but just saying, here's some coin, nah, don't do that.
Yeah, I think you have to get everything in writing, no matter what it is, any negotiation, any deal, any loan of anything, get it written down so it's there in paper, because handshake agreements, as good as they sound.
I thought you meant this. No, you know what I mean? I thought you meant this.
Of course, it's open to interpretation. I remember you saying it like that. When it's in writing on an email or piece of paper, I agree, that's it, the terms are discussed.
And that's a really funny thing. I'll look at sort of various business dealings. And again, you go back to learning from your mistakes. And this is probably one of the biggest messages in this conversation is a mistake is only a mistake if you don't learn from it. You know, if you keep repeating the same thing over and over again, and you're not learning from it, that's a real impasse for you, and you're not going to grow as a human being, whatever it may be. It could be in the dating space, it could be in the cooking space, it could be in your work conduct, it could be in it could be your fitness, it could be across anything. If you don't learn from your mistake, then if you learn from it, it's just an investment in becoming better at what you do. And you can't beat yourself up for it, but you genuinely have to get on top of that so you don't go down the same path again. And, if I look at contracts, for example, we you get someone say, oh, it's in the terms and conditions. Yeah, no, but I thought that. And it's like, well, no, the terms and conditions provide a black and white, binary, plain English, total explanation, not in font 1, but in font 20 that you can read to understand your side of it. And I remember I had to do with someone, we had a distribution agreement with someone, and he's a strange person at the best of times, I won't bother naming names. And we talked about something that was in the contract, and he said, yeah, but we've got these sort of within the spirit of our business. And it's like, no, this was the contract that we both signed.
Yeah, correct. That's what stands. Yeah.
Not, we feel that reading the tea leaves, and if the wind blows this way and your chakras are all lined up, that we're going to do this.
Yeah, no.
You can't operate in any kind of commercial basis like that. So black and white, contract it out, get a good contract lawyer to help you on that, and away you go. And this whole notion of asset protection is focusing on all of the negatives that are out there. How do you stop somebody coming after you? How do you make it more tax effective? How do you get what you're supposed to get out of the transaction? All those things. Success isn't about being a bully, because both sides are party to that conversation, and you can talk it through so it can be a really amicable agreement. And one such example, I had a call at the weekend with a new JV partner we're working with. We worked with one of his associates for 20 years. We worked with another of his associates for 17 years. He said, we're looking to do this. These two people both said, your name came up. Just text me how you want this to look in terms of the commercials, and it's done. That's a really interesting commercial arrangement. And we will paper it, I'm sure. But I guess you're coming in as a known quantity there where there's a lot of track record. My preference is always to get it documented, because then every party knows where you're coming in at.
So my question to you, AB, is we venture through this podcast to our small and medium-sized business owners out there listening to this. It's great advice, but they may be a little bit lost on where to start. Chances are they may hold businesses or assets in their personal name, and they want to maybe protect themselves. What are the first steps? What do you actually do from here?
Get advice. And we can put you in touch with our team. One of the great things about anybody in our ecosystem, whether you're someone that consumes this podcast, whether you're a client, whether you're on a far deeper relationship with us as well, is you get access to our Rolodex of people that can help you. So if you feel that you need help, feel free to reach out to us in the first place for that kind of advice, because as we've talked about in previous podcasts, professional service providers, there are good ones, bad ones, and intermediate ones. We've got excellent people we work with that can help you with that. If you're starting to put your head above the parapet and growing wealth-wise, and you're on a trajectory, getting that clear game plan of what all these things mean, how they work, and how they relate to you is crucial. Get yourself structured as early in the piece as it's commercially viable, and get it done right first time, because trying to change it is an absolute nightmare down the line. So you got to work on that in the first instance. Secondly, you can't be someone that owns, if you're a risk taker, you're a business owner, entrepreneur, you're someone that signed a personal guarantee for something, whatever it may be, you have to become, I guess, a man of straw, which is you own nothing.
Yeah.
So that there's the assets that you have are parked in a structure or through your, or in some way that you're going to get advice on away from you. So if you take the fall, there's nothing to see here. There's nothing to see here. So there's nothing for people to come after you for, because there's really nothing there. Sounds great in theory. You can get yourself structured like that in practice, but you need to do so in a way that is, I guess, ironclad to attack. And a lot of the structures that people use think, oh, that's going to keep me safe, don't always do that. So, that advice is absolutely crucial. And don't let this conversation negate your aspirations to want to have a good red hot crack in the money and investing space. This is just a step that once you've taken it and it's been explained to you, makes perfect sense. And I was probably, embarrassing to say this, true, 31 before I had any inkling on structuring advice.
Learned the game. Interesting. Okay.
I'd made a lot of money. I was quite vulnerable to that point in time.
Yeah.
And it was actually, I'd read, and we've talked about this in different things, Rich Dad, Poor Dad, Robert Kiyosaki, about the notion that business owners and what becomes open to you there as a business owner versus an employee, because I'd always been an employee, open that door. And then I got really great advice after that. But I was 31. So I got to the game late. Anyone listening to this, you're learning what I know now. You're standing on my shoulders. You're starting where I'm finishing. So there's no excuse.
Yeah.
Get the advice, learn it well, and then you can sleep at night. That thing of keeping yourself awake going, oh, I wonder if I'm covered here, is a thing of the past.
Gotcha. Yeah, I think we did a podcast on this a little while ago as well, which intertwines with this. You got to have a good team around you, a mentor, a lawyer, an accountant, a business advisor, whatever it might be, because these are the people that you lean on for this advice. Then you can just get to doing what you do best, which is doing your business, doing your thing.
You can enjoy it then. Without having to look over your shoulder. And there's nothing worse. You think about, to give a sporting analogy, and I've just had this conversation with one of my kids. They were racing through the paddock at the weekend, and I handicapped them, not in the physical sense, but time-wise. So, fastest, slowest, to give them a head start, just to even it up. And it actually worked quite well. They came in within a couple, I might have to start my job market making again, I think. And one of them was looking over, I don't look over your shoulder. Don't look over your shoulder, because you can't run like that. You're going to trip over, you lose all your mojo. And you see, in kids sport, someone's made a break in rugby and they're looking over their shoulder to see if they're going to get run down. They always get run down, or they knock on or drop the ball. You just got to and that's how you face forward and run at it. And I think in business or any kind of investing endeavor, if you're looking over your shoulder because you haven't done something, moral frame, you haven't done the right thing, or you're not structured in the right way, you kind of have that, I wonder if, you think, I wonder if I get a tax audit. If I get a tax audit, I'm done. You're looking over your shoulder, and it's because you haven't done the right thing. Get advice, do the right thing, and you don't need to look over your shoulder. You can enjoy what you're aiming toward, and hopefully that's a brighter financial future without the stress or anxiety of the risk of being poorly structured and somebody coming after you and taking what you've worked hard for.
That's it. Thank you very much, AB. Appreciate the advice.
My pleasure. Anytime, Mitch. There you have it. Make sure you like, comment, subscribe. Most importantly, hit that notification button, and we'll look forward to hosting you next week.